Welcome back to our channel. Today, we're diving into one of the most influential investing books of all time, The Little Book of Common Sense Investing by John C. Bogle. If you want to understand the secrets of successful investing, stay tuned. Let's get started. And don't forget to check out the link in the description to get your own copy of the book. When Warren Buffett, the best investor from all time, dies, he has left his wife a simple formula to manage all the money he will inherit. This simple formula, he learnt it from today's book review, The Little Book of Common Sense Investing. The strategy is so simple that even makes hedge fund managers or professional investors look no so smart after all. John Bogle, the founder of Vanguard Group, strongly advocates for index funds investing, which is a very simple financial investing instrument designed to replicate the performance from a large piece of the market, like the S&P 500, the Dow Jones, or the Nasdaq. These follow the average performance from a mixture of stocks. This instrument follows a big number of stocks from a sector or the largest companies from a specific country. Unlike active investors who buy and sell individual stocks and usually hold their stocks for very short periods of time, this strategy has led to very poor results for the average investor. These types of investors tend to have long-term performance lower than a simple instrument that no one manages, the index funds. Follow the following 7 principles to invest like Warren Buffett. Principle number 1, pay cheap fees when investing. Bogle's cost matters hypothesis is simple. The more you pay in fees, the less you earn in returns. When you invest in a mutual fund, there are several types of costs to be aware of. These include management fees, transaction costs, and taxes. Management fees are the costs paid to the fund managers for selecting and managing the fund's investments. Transaction costs are the fees you pay every time you buy or sell an individual stock. Because index funds are very simple instruments that no one have to manage, the average maintenance cost is much cheaper, and also because you are keeping your investment for a long period of time, you don't have to be paying the transactions costs. As an example, currently, the index fund, Vanguard 500 Index, has a tiny expense ratio of just 0.04%. This is one of the lowest on the market. Also on an index fund is much cheaper on taxes, and it is because it is a passive investment, the rates are usually 0 or very low, depending on the country you are. Bogle famously says, "In investing, you get what you don't pay for." Lower costs lead to higher net returns. It's that straightforward. Principle number 2. The magic of compounding. Compounding is the process where your investment returns generate their own returns over time. It's like a snowball rolling down a hill, gathering more snow as it goes. The earlier and longer you invest, the more powerful compounding becomes. Albert Einstein once called compound interest the 8th wonder of the world. Now let's explore a real-world example of the power of compounding. Let's say we have a 7% annual interest rate and a consistent monthly contribution of $300. We'll see how this investment grows over 10, 20, and 40 years. After 10 years, your investment would grow to approximately $51,073. After 20 years, your investment would grow to approximately $148,556. And after 40 years, your investment would grow to an astonishing $726,432. As you see, the snowball gets bigger exponentially. Principle number 3. Diversification is a key principle in investing. By spreading your investments across a wide range of assets, you reduce risk. Index funds inherently provide diversification by holding a broad array of securities within a market index. This diversification protects you from the poor performance of any single investment, ensuring a more stable and reliable return. Principle number 4. Don't try to outsmart the market. Bogle's idea that markets are generally efficient, meaning all known information is already reflected in stock prices and is public. This makes it difficult to consistently identify undervalued individual stocks. Instead of trying to outsmart the market, Bogle recommends passive investing through index funds. Trust the market's efficiency and let your investments grow with it. Principle number 5. Investing should be a long-term endeavor. Bogle advises against trying to time the market, which is notoriously difficult and often counterproductive. Instead, he advocates for a buy and hold strategy. By maintaining your investments in index funds over the long haul, you can benefit from the market's overall growth. Patience and consistency are key. Principle number 6, investor behavior is the key. Bogle discusses common behavioral pitfalls, such as panic selling during market downturns and chasing performance during market highs. He encourages investors to stay disciplined, maintain their investment strategy, and avoid emotional reactions to market fluctuations. Discipline is crucial for long-term success. Don't let your emotions dominate you. Build a strong character and self-control. Principle number 7, the beauty and the efficiency from simplicity. Bogle emphasizes the simplicity of index investing. Unlike complex investment strategies, investing in index funds is easy to understand and implement. This simplicity is a significant advantage. For individual investors, this means you can achieve great results without needing to become an expert or spend hours managing your portfolio. Finally, Bogle's creation of Vanguard and the introduction of the first index mutual fund were groundbreaking. Vanguard's commitment to low costs and investor interests has transformed the investment industry. Bogle's legacy lives on, helping millions of investors achieve their financial goals through simple, effective, and low-cost investing. And there you have it, John C. Bogle's The Little Book of Common Sense Investing. A must-read for anyone looking to invest wisely and effectively. If you enjoyed this review, please like, share, and subscribe for more book insights and investing tips. Thanks for watching.